Are you ready to take your first steps towards financial freedom by investing in property? Whether you're a first-time investor or you've started your portfolio but need some help continuing to grow, 2022 REB Buyer's Agent of the Year and Rising Star finalist Lachlan Vidler and his team at Atlas Property Group are here to help. As experts in property investment, Lachlan and his team are ready to help you take your next step in growing your portfolio. By completing the research, sourcing and negotiations, Lachlan goes the extra mile to find you a high-performing investment property. Visit atlaspropertygroup.com.au to book in your discovery call absolutely free of charge.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? Phil Tarrant, host of the Smart Property Investment Show. I hope you're well. Recording this just after Easter break, and for once, it was really good weather here in Sydney after what has been pretty bad couple of months here of the whole east coast of Australia, copping it pretty hard with the floods, etc. And we've been talking a lot about those things and what it means for property over the course of the last couple of months. So go and tune into all those things. If you're thinking about investing in Brisbane at some point, it was just a sage reminder that it does flood, and 1 in 100-year floods can happen within a month of each other. So buyer beware. Make sure you do your due diligence whenever you're looking at any properties which may be connected in or part of any sort of river system that can and will flood moving forward. This is not a podcast on climate change, but there is some clear drivers to how it's going to be shaping the weather patterns and the climate here in Australia, and what that, for the purpose of this podcast, means for property investors. So just one of the many other things you need to be considering about in the future. I note, and maybe the guy who joins me in the studio today has some commentary on this, I'll ask him about it. A lot of the waterfronts up and down the east coast of Australia, absolute beachfront, getting washed away, and there's a big question mark over a lot of those properties right now, particularly up into the regions north and south of Sydney, whether or not they actually represent good value or can you get insured. So maybe we can discuss today in the studio with me, Jack Henderson, Director, Henderson Advisory. We're going to get into this regional versus metropolitan debate. Jack, how you going?
Mate, it's good to be here. It's good to be here. Just my 2 cents on the waterfronts, mate. I don't think they're too worried.
You don't think they're too worried?
No.
Have you seen some of these beaches, these sort of south-facing beaches up the coast of New South Wales? And I think of beaches like North Entrance Beach. Where's some other, even down in Sydney here, like Collaroy and Narrabeen. Man, they're getting flogged, and they're just eroding. Absolutely eroding the beachfront locations, and they're having to shore up with sandbagging and rocks and retaining walls and stuff. And there's big debate over who should pay for it. I think if you're up on a cliff or a headland, you're okay. But if you're an absolute beachfront, you're going to get washed away at some point. Not concerned?
Mate, look, I mean, if you look at the data, these are the properties that perform the best out of any property in Australia. Like, it's the most premium land you can buy, right? Australians love water. So, if you make a couple of $1 million or, whatever, depending on where you're buying, obviously, a couple of 100% ROI on your money, putting a little bit of that percentage back into maintaining the property and building a retaining wall or, something that's going to protect your land from the elements, not a bad thing.
Anyway, maybe not really today's focus of the podcast.
I wouldn't be crying anyway, mate, let me tell you.
If you've got a nice absolute waterfront, some are good, some are bad, but you only need to think of the amount that sand dunes shift and move. Just when you get these huge king tides with big storms and all the other weather events, I think it's just top of mind for everyone. But Jack, mate, what's been happening? You're sort of back in the studio after about a month hiatus, and you sort of regular guest for us. What's been going on, mate? Just
spent an amazing weekend in the beautiful weather like you were talking about, which was great, especially in Sydney on the water. So, mate, feeling recharged, fresh. I've got my Birkenstocks on because obviously we're in between Easter and Anzac, so it still feels semi-holiday mode.
And I think a lot of people are semi-holiday mode at the moment. I think if you took 4 days off, Tuesday, Wednesday, Thursday, Friday, you got 11 or 12. So a lot of people benefiting from that right now, which is good. But you mentioned beforehand when we last got together, we spoke a bit about your portfolio and the way you see the world. But to your sort of baseline philosophy, you're enjoying a few bucks now that you've been working hard building out your business and investing in property. So you are enjoying the trappings of whatever that generates for you.
Of course, yeah. I do struggle with it, to be honest. I struggle with the frugalness and always wanting to be better and grow bigger, and then also enjoying life at the same time. So it's a fine balance.
Yeah, you're just doshing out money all over the joint. Is that the way it works? Things are expensive, right? If you want to start enjoying all the boys' toys and whatnot.
Well, because like I spoke about it before, I've obviously have people I aspire to be like and mentors and all the rest of it. And if you follow people like Warren Buffett, for example, he's the most frugal man in the world.
Still drives the same car, right?
And you're like, well, is that the right way? Or is, the polar opposite the right way, where people have got 1/10 of his money or 100th or 1,000,000th of his money, and they live a much better lifestyle. So it's the balance of, should I be spending X amount of dollars on a boat or a car, or should I be putting that back into the business or investing?
Yeah,
I don't think there's a right or wrong answer.
It's
right?
not horses for courses is where we'll leave that one. So regional versus metro or urban style investing, and we'll get into some of these definitions right now, because you have regional, you have rural, you have rural, you have regional, you have metro, and you also have urban. And I reckon let's deal with metro and urban. Metro, I would say anything. The easy way to define it is anything with a metropolitan postcode, according to the Australia Post, is probably the easiest way to do it. But then you have urban, and urban would be places, I think, like, which are metro. It depends. The debate's still out. Newcastle and Wollongong, or these Geelongs, for example. Like, these are still metropolitan areas, right? Like, they have all the trappings of metro type areas. You sort of agree with that consensus? That is the definition?
Yeah, look, I don't really buy into it too much. Metro, regional, it's like, what's the classification, right? Like you just said, it's different for every single person. So I think the way you define it's really good.
Yeah.
To Metro for Australia Post. And
Metro for Australia Post. And I think that's also to give some sense for how banks consider you. They probably use, a lot of them have their own ways what they measure the difference between regional and metro, but a lot of them take their clues from Australia Post. So just Google metropolitan postcodes and you'll be able to work it out pretty quickly. And you can get your red pen out of a map of Australia and you probably circle what is metro and what is regional. Regional versus rural, I would sort of say regional is somewhere out of the metros, but maybe a large city. Armidale, Bendigo, Tamworth, Bathurst, Orange, all these sort of places. And rural is like cows and stuff.
Rural is cows.
Big sort of, which is its own specialisation in real estate, is big, like rural holdings, large acreages, that sort of stuff. So again, banks take a different view to that. But what's your overall sort of baseline philosophy of regional property and metro property? Because a lot of the readings I'm seeing right now, and we're covering a lot on smartpropertyinvestment.com.au, is that you're getting this sort of two-speed market at the moment where your Sydneys and your Melbournes have flatlined or coming back a bit, but you have a lot of regional areas which are still driving ahead at a rapid rate. I think of the Central Coast, for example. It's absolutely nuts. Good money to be made in regional property?
In the short term, sure. Like, you have to look at who the buyers are in these regional centres, right? And they're not regional buyers, they're city buyers. Like they're investors, they're, people making the tree change because they think their boss is not going to make them come back to the office. Like, that's what is driving these marketplaces at the moment. And that's why I always talk about looking at a proven track record of performance. Who cares about what happens in the short term? Like, you can make any little bit of data look good in the short term, right? Like, you look at you always see, bits and pieces from different outlets where it's like, oh, the area that's grown the most over the last 12 months, or, the next hotspot. And a lot of these areas are like new house and land packages, right? Because they release a heap of land. The established properties there are worth $400,000. They release land, they buy in new house and lands for $650,000. So it looks like that area has gone through this significant growth. But the reality is they're just two different products, and it's just, making the data look good. So I think in the short term, some regionals will do really, really well. I think over the long term, they will not. If you look at the top 10 regional hotspots or the places to invest from 2010, 2011, we did a study on this recently. The average growth rate of those locations over the last 10 or 11 years has been 3.6%. Think places like Mackay.
Yeah. Mackay's pretty far away.
It's regional, right?
It is absolutely regional. I guess, there's a lot of people who advocate regional investing, and rightfully as well, and they've got a lot of numbers and science around it. And you see the performance of some of these regional markets. I think it's property investors really need to frame it correctly, as in what is regional. And there are some regional towns which are bigger than some of the capital cities.
Newcastle is the 7th largest population in Australia.
Yeah. And you think of Darwin, you think that's a capital city. It's pretty small, right? Like, I think Wyong is bigger than
Darwin.
So to give you a sense for it, so you've got to try and get out of that paradigm of capital city regional. A lot of these regional towns have large diversified economic bases. They're sort of mini cities in themselves. Goulburn, for example, is quite a large place. It's been doing really, really well. How do you sort of differentiate between regional and sort of metro markets? Or are you die in the wool sort of city investor? Don't go into the regions.
No, I wouldn't say we're diehard city investors. And, I think a lot of people misunderstand the term blue chip as well, right? Because everyone thinks blue chip, they think Vaucluse and in Kirribilli, and, they think it's millions of dollars and they can't afford to buy there. So let's buy a regional because it's more affordable. My definition of blue chip, which compromises of both regional hubs, so not just regional towns, hubs, places like Newcastle, and metro or, like cities, for example. The definition I have of blue chip, which is compromises both of these things, is a proven track record of performance. That's what I look at. So regardless if it's metro, regardless if it's rural, regardless if it's regional, I want a long-term track record of consistent performance. Not COVID hit, everyone's moving to the country, we've got 3 years of really strong growth because there's been hundreds of billions of dollars pumped into the global economy. Every market's doing well. You don't have to be an expert to make money at the moment. But if you look over the 30-year time frame, there's a lot happening in that 30 years, right? There's a really good book people should read, not based on property, but it's based on the overall monetary system and how the world works, by Ray Dalio, called Principles and the Changing World Order. Really good book I recommend people should read. And it's just an understanding of how things work and how the monetary system and the debt system works in the world, which obviously affects the property markets globally. So if you look at a 30-year horizon of what's happened, there's been so many events, right? There's been GFCs, there's been dot-com bubbles, there's been COVID, there's been interest rate rises, there's been interest rate decreases, there's been floods, there's been bushfire. Like there's just been so many events. So it gives you a really good sort of magpie or bird's eye view of how that market has performed over those changing times, right? And if a marketplace hasn't done well over those changing times, betting with that marketplace that is going to do well over the next 30 is a risky move in my eyes. Sure, you may bet right and it could do really well, but you could also bet wrong. And a lot of people, what I find, like we spoke about, 97+% of investors stop at one. Yeah. That's because they buy the wrong asset. So I believe the most conservative approach and the most guaranteed approach is going, what's done really well over the last 30 years? Consistent. Not 30% one year, 9 to 10 the next, like consistent 7 to 10% year on year, and buy there. And whether that's Adelaide for 500 grand, whether that's Newcastle for 800 grand, whether that's Sydney for 1.5 million, whether that's Brisbane for 900,000, Melbourne for $1 million. Like regardless of what it is, have that philosophy and have that mindset of, is there a proven track record? Does it have a diverse range of jobs? It's not based on one sector, like Perth, for example. Very, very cyclical to mining, right? So, probably not the best marketplace to invest in.
And that philosophy sort of makes a lot of sense. You're just looking for consistency. So if something's happened, trends in real estate, the reason why people absorb themselves with data is they look for trends. And if you've got a 30-year trend of steady, stable growth, one would assume that something drastic would need to happen to put an end to those same dynamics to give you that steady, stable growth moving forward. And Adelaide, you speak about Adelaide's been one of them steady performers for years and years. It never knocks the sky out, but it's always performing quite well. A lot of people have built very good portfolios out there. And you sort of touched on it before, and I want to get into it a bit around data. And I want to understand how you use data to make these decisions, because I take from you're saying regional or metro, largely irrelevant. Look at the fundamentals of these places and it'll tell you, it doesn't matter where it is, whether or not it's going to keep growing. But let's chat about data. We'll just go to a quick break beforehand. Stay with us, everyone. Back in a moment.
Ever wondered how you can invest like the top 1% of Australian property investors? Henderson Advocacy has been at the forefront of helping everyday Aussies improve their financial freedom. So if you're a savvy investor or someone just starting out on their property journey, give Henderson Advocacy a call today. Head to www.henderson.com.au. Don't invest alone. Invest smarter.
Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show, with Jack Henderson from Henderson Advocacy. I always struggle with that word.
It's a tongue twister.
Advocacy.
Advisory, advocacy, whatever you want to call it.
Advocacy.
Just Henderson.
There's a Henderson. Is that what it'll end up being one day? Just Henderson.
It's going to be a H. It's actually just going to be a red dot. That's going to be the end goal. Yeah. Like the Nike tick.
It's all you need. Or Target, everyone knows what it is.
Target in regional hubs.
Mate, Target, I'm telling you, it's a good way to work out where you should be investing is follow Target around where they're building new places. Man, that's rocketing along right now. I do like Target, Big W, Kmart. All the great places. But there's always a couple of words I struggle with. Like I really always struggle. I don't know if you got any of these struggle words. I struggle with trajectory. I always struggle with that word.
Yeah, well, mate, as you know, I didn't finish school, so mate, there's a lot of things that I struggle with.
Trajectory, but let's talk about data and trajectory. You mentioned beforehand you look at data, but you use a really good example of places that are selling for $400,000, and then a whole new suburb goes in next door, or a new sort of land release, and it resets the price at $650. So everyone thinks, wow, look at this place is growing rapidly. Not really the truth. You got to get down there on the ground and actually know what's going on. How do you balance data and using data for you to make informed investing decisions versus going out there and actually having a look around? Do you still need to do that, or can you do everything from data?
Yeah, look, I believe people get too caught up in data. Like you can, like I was just talking about earlier, you can make data do anything you want. You can make an area look amazing. You can make an area look there's so much irrelevant rubbish out there that I personally believe does not matter. Like I'm talking about. Proven track record of performance is the best way to understand if an area is performed, if you're not gambling. Speculation, sure, look at data, look at trends, look at what infrastructure's coming, blah, blah, blah. Do that. Awesome. That's not our play. If you can look at a location, it's got a very diverse range. This is the important stuff. What the median income is for the area. Is that median income rising, and what is it made up of in terms of employment? You look at a mining town, the median income looks incredible, but it's reliant on one sector. Mining. Probably not the best thing to do. Same as areas where there might be a big, Navy base or whatever it may be. If they're very reliant on one sector, it's probably not the best area to buy because it's very cyclical and can be susceptible to change. So what's the median income? Is that rising? What is the median income made up of? How much scarcity is there to land in the area? In blue chip locations, there's no land available. So whatever is there right now is likely all there will ever be. And very rarely will local governments allow the rezoning of land to change an area. So you're pretty safe. You obviously need to look at what these people do, what are the drivers for their lifestyles? If you go to a rural town, what do these people do? What if someone's moving from a city to a rural town, why are they moving there? Is it because, again, short-term metrics, they're sick of the city, sick of traffic, we're going to the city, we're going to, live in Tamworth or whatever it is. And then the reality kicks in 3 years later that there's nothing to do there and they travel back to the city every 4 years. Probably, again, not an area that I would buy into. And then consistent growth, not 5-year growth, not 10-year growth, 30-year growth. What was the median 30 years ago? What is the median now? Sure, you got to take into account things like if it's an old area, things like renovations. So that can obviously play with what the growth figures look like. But you can dive down into this as much as you want or as little as you really want. And if you follow just the high-level fundamentals of good quality locations where people have high affluence, there is a growing population, there's lifestyle drivers there, there's a huge amount of scarcity, and the marketplace is dominated by owner-occupiers, not by investors, and the growth is derived from owner-occupiers, you will do well over the long term. Yeah, because a lot of markets are remote, especially rural and regional, if we're classing them as regional. At the moment, the growth is not driven by owner-occupiers. It is not driven by mum and dad who want to buy a bigger house because they've got a better job. That's not the driver. The driver is Sydney, Melbourne, Brisbane investors who have made a lot of money recently through growth. They're refinancing and they're going, well, what can I buy for 400 grand? What can I buy for 500 grand? All of a sudden, they're buying into these areas, investor-driven. The paradigm shifts from owner-occupier dominated to investor-dominated. All of a sudden, the rental stock increases. And as soon as the marketplace shifts or something happens in the macro economy, investment properties are usually the first things people sell or offload. And,
And here we are, middle of April, as we're gearing the federal election. I'll ask you about that in a moment. But you see that they're plugging. They're out there campaigning hard in regional Australia. Both parties, the government and also the opposition, looking to try and win favour there. I reckon over time you're going to see a bigger focus put towards regional Australia. I think it's absolutely imperative as a food basket for the nation and the driver and an engine of a lot of economic growth and development. So interesting to see where they are playing at the moment, trying to attract more people to regional areas, both to live, businesses to operate there. And I've said it beforehand, I reckon Elon Musk's going to be one of the most influential people in Australian property over the next sort of 3 to 4 years, purely because you can get Starlink internet now in these regional areas where before you only had ADSL internet speed. So it's a complete game changer. That will change the way in which people live and work. But something you mentioned I really want to touch on, you spoke about like Navy bases, right? So how do you balance, maybes and could ifs? And this is the risk side of things. We sort of know that Port Kembla is the sort of the pick of the list for a new Navy base for Australia, or at least on the East Coast, for the new nuclear power submarines, right? So they're saying, hey, we're going to consider all these areas. They spoke about Newcastle as well and Brizzy, but Port Kembla looks like the pick of the bunch. Should everyone be rushing out to try and buy property in Port Kembla because there's going to be a huge infrastructure development there and a new economic driver potentially, or do you got to sit and wait until it's formally announced and you actually know what the plan is around it? How do you balance these sort of things, as in quick, get in there because you could make a lot of money versus it's still pretty risky?
Yeah, simple answer is I don't. I don't care what's going to happen in Port Kembla. Has Port Kembla performed for the last 30 years? Yes, then invest. And if this happens, great. If it doesn't, you're still going to be pretty safe.
Yeah.
But if it hasn't performed, then that's not investing, that's speculating. And sure, if you've got a really strong foundation of property, you've got 3, 4, 5 properties in the portfolio and they're in good quality locations which are providing consistent growth, then you might have some money to then go play and, be a little bit speculative with. And, people talk about developing and all the rest of it. You can do that when you've got the money to say, oh, well, it's not good to lose money, but if you did lose some, it's not going to completely end your investing career or, give you a major setback. But I think too many people try and make quick money. That's the biggest killer for any investing, like whether it be business, whether it be property, whether it be crypto, NFTs, all the shit that people buy is all based on short-term metrics and making quick money.
Yeah.
That's the fact of it. And if people are out there trying to chase and make quick money, then easy come, easy go.
Yeah.
That's
so what you're saying then, when you're a bit more of a mature investor, you can start having some more speculative investments. But back to that Port Kembla example, if you go and look at the numbers, that's performed exceptionally well over the last sort of decade or so. So that would only be an amplification effect,
of course,
if that was the case. So,
but a lot of the people who live in Port Kembla, it's still close enough to commute to Sydney to work. So you've got Sydney employment on Sydney incomes living in an area that's within an hour and a half.
Yeah.
So
and that's it, right? And then again, this is this sort of regional and metro dichotomy that you have right now. And these are the areas that are performing. I was only on realestate.com there last night, and they're talking about these, these suburbs an hour 15, hour 20 from the city CBDs are absolutely booming right now. Down like Helensburgh, up in, the areas in the Blue Mountains, out Windsor way, Freeman's Reach, that whole area out the back of Sydney is all booming because you can get into the city, but you can actually get more for money out there and still build a lifestyle and stuff. So it's super interesting stuff. But I think the stat you use, 97% of all investors only have one property. I think the reason why is exactly what you're talking about, and that is they go, oh, I reckon I'm probably going to have one play this. So I'll try and make a lot of money the first time around. So they've gone and bought properties, and you think a decade ago in Port Hedland or Moranbah, these mining towns which had ridiculous amount of growth and a ridiculous rents and rent increases. They were yielding off the charts, right? But when mining stopped, most people are still stuck there with houses that they probably bought for $700,000-800,000, which are today probably only worth $250,000-300,000. So they're probably the cadre of people you're talking about, where they just make the wrong investment first by buying stuff like that.
And that's the extreme, right? They're the people who have made very bad decisions on short-term metrics. But if you look at, even things like the Sunshine Coast, for example, a lot of the Sunshine Coast now is doing exceptionally well, accessible to Brisbane, the Gold Coast. But if you bought the wrong asset in the Sunshine Coast, like an apartment, apartments have done nothing there for the last 20 years. My parents bought one of those, in a place called Surf Air, Marcoola. $330 purchase price, $350 purchase price, $330 sale price 11 years later. I looked the other day because I spoke to someone and they said, oh, Sunshine Coast this. And I was like, oh, I'd be interested to see what these apartments are worth now. They're the same. But the Sunshine Coast overall has done really, really well. But it's the kind of property you buy in that location,
so asset
right?
selection, right?
Exactly. It's the asset selection inside of the location that you buy. And again, the house v apartment debate, just as much as the regional versus metro debate. You can buy the best quality property in a metro location and still do bad because you bought the wrong asset. And then vice versa in a rural or regional location, you can buy the wrong asset in a regional location.
Yeah.
And when you buy a property, you're buying a property on a street inside of a suburb. You're not buying the whole suburb.
Yeah.
The really important part is, asset selection on top of the location selection.
And this is, again, the stuff that's probably in your control is what place you buy. Whether or not something's going to go up in value, you probably don't have too much control over that. And there's so many environmental factors, and you spoke about them, through the years, these sort of seismic shifts. And you think, wow, it can never get more disruptive than what it is right now. You think, the immediate history or current history of the COVID-19 pandemic, like what else could happen that could be more disruptive than COVID? Well, people have been saying about it, for years, the Great Depression, global wars, the GFC, other health pandemic like SARS example, as one example. So guess what? There'll be more stuff around the corner.
This book that I was just saying to people, The Changing World Order by Ray Dalio, it looks at thousands of years of history, global history, not just Australian history. And there is so many things that have happened in the world that people in 2022 have no idea about because they look at such a small segment of history, right? But there will be something else. And if you look at the impact COVID's had on the overall economy in comparison to, say, the Spanish flu, not even a comparison. Like COVID is like an ant against a T-Rex. Like the Spanish flu had killed millions and hundreds of millions of people, I believe. Like in comparison to, and like the shift in wealth and like it's very, very interesting, and there will always be something else. Yeah. And that's why I think, taking a long-term view is so important, because we look at such short-term metrics that, move the needle by such a small amount.
Yeah. Yeah. You got to sweat the small stuff, but you got to be thinking about the why in the long term, right? And this is about, how do you build out a portfolio? Why are you building it? Some people build a portfolio because they want their grandkids to actually reap the benefits, right? Who knows? But you need to actually have some sense of the maturity cycle of your portfolio and where you're going to go with it and how it's going to work. And you think of, to your point, people sort of investing in the immediacy of what's happening right now, what happened last week, what happened last month. And it's the 24-hour news cycle. It's like, quick, this probably went up by whatever or down in a month, right? Like, who cares?
I saw the first quarter results, and obviously realestate.com, their job is to get clicks and to get traffic to their site, right? So they're posting content that drives that. And like, wow, who were the performers in the first quarter of 2022? And it's like all these areas, and you're like, people buy into it. It's
you got to be careful. Well, that funny sort of vignette is someone asked and this gives a sense to the way the Chinese think. Someone asked the Chinese foreign minister what he thought about the French Revolution, and he said, "I don't know. It's too early to tell." The scope of like the generational thinking of different people. We're here in Australia, and the election, we're thinking about, oh, wow, fuel's really expensive. We'll sort it out for 6 months and remove some fuel excises and then that'll fix things, right? So as a property investor, to channel that same notion, you've got to be thinking about the long-term benefits of owning and holding property for your lifetime. And you might, towards the back end of that, sell everything and go and buy one of those apartments on the world cruise ship and just live on a cruise ship. Like maybe you want to blow your dough and do it that way. But let's chat quickly politics, because it is very timely. We'll just go to another break. Stay with us, back in a moment.
It's time to get help. Interest rates are increasing. Inflation has hit an extraordinary 5.1%, and the chance to secure a golden egg property is getting narrower by the day. Dragan from Buyers Agency Australia has been presenting the facts and helping property investors make smarter, well-informed, educated decisions in property for years. So what are you waiting for? Get in touch with Dragan today at www.buyersagencyaustralia.com.au. Invest with integrity.
Welcome back, everyone. Phil Tarrant from the Smart Property Investment Show with Jack Henderson from Henderson Advocacy. He's a director there. Now, we're about a month out from the election. Is it one of those, so what, not going to do anything to property prices, not going to really shape or influence how you invest in real estate?
Man, I don't even vote. I just get fined. I'm not kidding. Like, it doesn't matter whether it's Scott Morrison or Albanese or some other punter. Like, who cares? Like, these people will not save you. They're not going to. These people are not going to be the catalyst to you having a great future or a bad future. You are, the individual. So what happens, I don't know. I don't really know what their policies are, right? It's like...
I don't think many people do. I
think I saw something the other day, the first time buyer scheme, they increased from 10,000 to 35,000 applications, and they increased the purchase prices from, in New South Wales, I think it's
up to
800 to 900 now, which is great. That's the only thing I need to worry about. It's property. It's going to have an impact on that segment of the marketplace in the short term. Awesome. Nothing else.
Yeah. And I was chatting about this the other day with Tom Panos, actually. And the last election was largely fought around, well, a lot of the policies fought around policies that would shape property investment, saying we'll get rid of negative gearing, we'll start sort of levying self-managed super funds, all this sort of stuff. And a lot of people went, oh, no, don't mess with property. So at least the Labor government's come to this election pretty much going, yeah, we're going to leave everything as is, right? So that's what spooked a lot of property investors last time around, whether or not that is...
Labor are smart. They didn't want to touch it because it probably shoot a lot of, voters away to the other side. So...
Well, Albanese is a property investor. He's got a property portfolio. I'm sure he doesn't want his
most
negative
of them
gearing mixed up. And they're all disclosed. You can actually go and find out what they got. It's all on the register. But
it's the same as the interest rate rises. They're going to rise. Like that's the reality of the world, and they're probably going to fall in a lifetime, as well. So, it's not always going to be happy, dandy roses, lots of money out there and times are great.
There's lean years. There's always lean years.
It's just life. But again, people look at the microscope. Oh, you're silly to be buying now. Your interest rates will go up by 1%. And so no worries. You keep living that life. It's a mindset thing. It's obviously the way that those people were brought up and they live scarcely. And the people who live abundantly and realize that short-term metrics don't have an impact on long-term thinking will continue to thrive and pivot, And I think another thing too is property investing over in certain periods, you're not going to see growth. You're not going to see rents rising. You're probably going to see some tough times and you actually might have to offload some assets or it's life. There's this thing called life that happens to all of us, and when times are good, your lifestyle is great. And I'm a normal human being, right? Times have been great in the property market for the last 3 or 4 years. Business has been great. You live a good life. But if times change, you adapt to that change and you do live a little bit leaner and maybe you don't, live in the X house or, drive the car and all the rest of it. You adapt with the changing times and you might keep a little bit more powder dry. So I think it's just life and people get so caught up on short-term things.
I think there's a lot of merit in what you're saying there. For the immediacy right now though, to the point, there's a lot of people who aren't buying property at the moment. The properties are coming on market. It's probably good for you as a buyer's agent because I'm starting to see the balance of power swing back to the buyer's agent rather than to the sales agent, right? I'll ask you about that in a moment. But a lot of people are going, well, they've decided to list their house, so they're still putting the house up for listing. But a lot of people go, I'm not going to buy at the moment because rising inflation, there's an election on. So there's this magic window for a lot of investors of a month where you can probably, a little bit after the election as well, where you can make hay if you are ready to buy and ready to go. But are you seeing a shift in how agents are dealing with you and your buyer's agents at the moment? You're getting a few more phone calls these days?
Yeah, 100%. There's certain points in time, like you just said, certain windows where it's very, very good to buy. And I did a bit of content on this recently. I believe at peak uncertainty is the best time to buy because as soon as normality returns and the headlines shift, then people get calm again and, then they start buying and then you're buying in competition, not in isolation. And generally what happens is, there's only a certain percentage of good quality properties. Everyone wants those properties. You're then, in competition with people. You end up paying more for those properties. It's not a bad thing, but, if you can buy now, have a little bit more courage, have the long-term oversight, understand that regardless if you buy a property today or you buy a property in 12 months' time, you're not buying it for 12 months, you're buying it for 10 years. So what does it really matter? Then there's great buying opportunities, very, very good buying opportunities. And we're seeing, properties that would have achieved a premium of maybe 10% November, December last year coming into Christmas, now we're buying 10% cheaper. And it's not that they're decreasing prices. It's just that, the guide prices on what they were getting 20 or 30% premiums on top of, they're not getting that anymore. And it's sitting more around that overall guide. So, I think it's great. And like I said, we work with some pretty wealthy people and they're not scared. They're out
there buying.
Yeah.
It's the way to go. Where are you buying at the moment? Give me a suburb.
Mate.
Not you personally, but as a company.
Oh, for a company?
Yeah. For Henderson. Where's Henderson buying?
Mate, last week
Give us the secret sauce.
We would have bought 3 in Newcastle and Newcastle and Sydney we bought 3 between the two. Kensington was the one in Sydney, which is, it was a house. Newcastle, we're buying areas like Mayfield, buying areas like Adamstown, we bought one in. So again, sort of 2 to 5 k's from the CBD.
Yep.
Adelaide as well, places like Unley.
Yep, Unley's good. Yeah, Kensington out by the university there. House out there, that's got to be worth, what, 2.5 these days?
4. But
4?
Yeah, 600 square metres of land, and that's a full renovator that they'll turn 4 into 6.5 in 12 months.
Really?
Yeah.
Wow. And that's it also, we're moving into this cycle where the market won't do the heavy lifting for you. You've got to start thinking about, and there's probably going to go to asset selection, moving that cycle as well, where there's many left, but how do you manufacture equity in these places, like buying for 4 and doing a reno, getting uplift.
But I think that's another thing as well, which I wanted to quickly cover, is that it doesn't need to be 4 to 6.5. It can be 400 to 650.
Yeah.
It's all relative, right? And we buy property for people who are spending 450 as their first investment, and we buy property for people spending $4 to $10 million.
Yeah.
Like that's the range, but the fundamentals we use to buy the property remain the same. And it's all relative to where you are in your journey. It's relative to your income. It's relative to your ambitions and goals. So blue chip doesn't need to mean expensive Sydney real estate. It can mean the blue chip fundamentals in a more affordable location, which may still be in a capital city, but maybe in another capital city like your Adelaide, like your Brisbane, but all the fundamentals remain the same.
Yeah,
and
I agree.
your performance
with that.
generally is relative to what you're spending as well, right? Like if you're spending $4 million, you're generally going to get a much better quality asset.
Yeah, and even if you want to use Sydney as a paradigm, Sydney largely is a city. It's an aggregate of probably 10 satellite CBDs, right? You think Campbelltown, Liverpool, Penrith, Blacktown, Hornsby, Sutherland, etc. So there's blue chip properties in those little micro
markets.
Cities and markets, rather than blue chip doesn't necessarily mean there's to be 2 kilometres from the Sydney CBD.
Of course.
There's blue chip stuff in Blacktown, right? Because it's got all the different fundamentals and benefits from it.
There's $8 million sales in Castle Hill in Dural now. There's $8 and $10 million sales in Brisbane now. There's $20 to $40 million sales in Melbourne. It's not just Sydney that's expensive.
Yeah.
And then inside of all of those marketplaces, there's more affordable properties. But I think you still need to follow that
same
blue
logic.
chip fundamentals.
Close to this question, you mentioned sort of you buy for people who are buying 400,000 start their investment journey, and people sort of 4 to 10 million, right? Probably the other end of sophistication when it comes to where they are as investing. Do you reckon it's the 400? I think back to where I was, and I was probably one of them. The 400,000 investors sweat it a lot more than the $4 million investors.
Not at all.
No.
All the same. They, it doesn't matter if they're spending, because it's relative to where they are at that journey, right? So 400,000 to someone who is making 80 grand a year, and 4 million to someone who's making X amount of hundreds of thousands a year. It's the same thing. The thing that is common amongst all of my clients who spend millions of dollars at the mid to end point of their investing journey is that they have made a significant amount of money buying consistently over the long term, and usually through their owner-occupier home.
Yeah,
that is what's consistent.
So that's a common thread.
So if you common.
So they've bought a principal place residence and it's gone up in value, and they've just traded it.
And the reason for that is because they buy that property with emotion. So what do they buy? In good quality locations, close to amenities, close to schools, close to everything that they love as humans, and they're usually in a good demographic. People who invest in property are usually aspirational people who want the better things or the finer things in life, right? So people who are spending that type of money have usually made the majority of their wealth through their owner-occupier home. They've bought for 600 as their first, sold out for 1.2 8 years later, and then upgraded to 2.5. Then, 7 or 8 years later, they've sold out at 5, upgraded to, and it's all relative, right?
Yeah.
So you might sell out for 400 to 8, 800 to 1.2, but usually people make their majority of their wealth through their owner-occupier home, and because they're paying down principal off that debt as well,
just amplifies it.
It continues to build
and
wealth.
And they don't have the tax at the back end of it as well, because your principal place residence is exempt from.
And that's what it's so evident to me that because people buy these owner-occupier homes with emotion and they buy for all the reasons that an owner-occupier buys, then they make a lot of wealth and they generate a lot of wealth through that. But when they invest, they forget about all of that. And that's the quick
a lot of people say you should
thinking.
invest by the numbers rather than emotionally, but I guess the best way to do it is do both of them, right? Invest well in your principal place of residence because it is tax exempt, but you don't get all the benefits of the taxation around it, as in you can't deduct your interest payments, etc. So if you can do both of them, as in, a lot of people will create that wealth through time or manufacture it, pull some money out, start investing in it as a property investor. So typically find if you do both, you're probably the best off.
Absolutely.
Anyway, Jack Henderson, thanks for coming in, mate. Always enjoy the chat.
Always
we cover a lot of ground.
Never a chore.
No, it's really good.
You on heads or tails for 2 up on Monday?
I'm a heads man.
Tails never fails, mate.
Yeah, tails never fails. Where do you go?
I don't drink, so.
No. But you go and play tour?
No.
No. It's,
it was a good way to wreck that question, mate. You know, just trying to be one of the people.
One of the people. You are a man of the people. Go and check these guys out. You Google them, you'll find them. Jack Henderson Advocacy. I hope you enjoyed that, everyone. Thanks for joining us. Always good to chat through property. If you want to come and have a chat with us on the show, make sure you get in touch. We really enjoyed chatting with property investors. Email the team, editor@smartpropertyinvestment.com.au. We'll get you in the studio. Social media, Smart Property HQ, if that's how they get your info. Quick favour for me, if you like what we're doing here, it's just not myself behind the mic. We've got a great team that do all the heavy lifting and make me sound good. They get a real kick out of those reviews. And I think Jack is doing it right now, leaving a review. I think he's already done one, actually, on the podcast channels. If you do that for me, it'll be a great favour. I'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
It's safe to say the property market has been red hot over the last few years, with some of the markets we've selected in 2021 rising over 40% in a 12-month period. It's very likely that if you're a property owner, your property has gone up 20% minimum in value in the past 12 months, and you have most likely accrued sizable equity that can be recycled and extracted to build your investment portfolio. With interest rates increasing, you might be wondering where to invest to maximise capital growth and cash flow in 2022 and beyond. Well, to save you time, energy and guesswork, award-winning author and regular guest on the Smart Property Investment podcast, Paul Glossop and his team at Pure Property Investment have outlined the top 30 affordable suburbs poised for strong capital growth over the next few years with sound cash flow. Grab your free Top 30 Guide to Property Investment Guide today at purepropertyinvestment.com.